All right, let's talk about something every single investor runs into. It's that classic battle between your gut reaction to some scary headline and the smart, disciplined plan you're supposed to stick with. It's that fight between panic and patience. And honestly, the winner of that fight pretty much decides your financial future. So let's just jump right in. Picture this. You wake up, you grab your phone, and bam, the markets are in total chaos. Everything's dropping, the news is screaming crash. What do? What's that very first gut level instinct? Yeah, for almost all of us, that little voice in our head screams, sell, get out now before it gets worse, right? But then you remember all that advice from the experts, from the books, all of it telling you to just stay calm, to hold on. And that right there, that's the investor's dilemma. So let's really dig into this. What is actually happening inside our heads when the market starts to go haywire? What's so interesting is that urge to sell isn't some kind of logical failure on our part. Nope. It's actually our ancient survival wiring kicking into gear. Research from Bernstein points this out perfectly. It's that fight or flight response that kept our ancestors alive when a saber-toothed tiger showed up. The only problem, it's a terrible, terrible guide for dealing with stock market swings. And this internal tug of war really boils down to two completely different ways of thinking about investing. Let's lay them out. First up, you've got buy and hold. And really, it's just what it sounds like. You buy good assets and you hold on to them for the long haul. The whole idea is to completely ignore the crazy day-to-day noise, believing that over time, things will grow. And this slide just lays out the difference perfectly. On one side, you have market timing. That's an active game of trying to be a fortune teller. And think about this. You don't just have to be right once when you sell. You have to be right a second time when you decide to jump back in. On the other side, buy and hold is all about chilling out, trusting in the big picture growth of the economy instead of your own crystal ball. So the big question is, which one actually works? I mean, market timing sounds awesome if you can pull it off, but the actual data, well, it tells a pretty one-sided story. I mean, this quote from Bernstein Research just hits the nail on the head. Unequivocal. That's a strong word. The evidence is just overwhelming. Trying to dance in and out of the market usually leaves you with way less money than if you had just stayed put. And here's the proof, right here in black and white. Look at this. Over a 25-year stretch, the stock market itself returned about 9.1% a year. Pretty good. But the average investor, they only got 3.3%. That huge gap, that is literally the cost of fear. It's the money that vanishes because people try to time the market and, well, they get it wrong. That's a shocking difference. So why are the results so much worse for market timers? Well, apart from the fact that predicting the future is, impossible, there's this other hidden trap that a lot of people just forget about: taxes. Every single time you sell for a profit, Uncle Sam wants a piece of the action. Okay, let's crunch the numbers for a second. This is fascinating. This chart shows how far the market needs to fall after you sell just for you to break even with the person who did nothing. So if your portfolio has doubled, you're up 100%, and you sell, the market has to drop a full 14% just for you to get back to square one. Why? Because you had to pay a chunk of your profits in taxes. You're starting the race from behind. Okay, so we've pretty much busted the myth of market timing. It's a tough, expensive game to play. So let's flip the script and talk about the alternative: the incredible power of just being patient. This slide shows just how incredibly resilient markets are. Bankrate put together this data on huge global shocks. I mean, we're talking Pearl Harbor, 9/11, major wars. And yeah, the initial drop is always scary and painful, but look at those recovery times. They get faster and faster. After the September 11th attacks, the market was back to even in just 31 days. Amazing. So the takeaway here is pretty simple. All those terrifying headlines that make you want to sell everything, historically, their impact is surprisingly short. The initial panic is almost always an overreaction. And this right here, this is why time is the ultimate superpower for an investor. Look at a one-year period. It's a total roller coaster, right? You could be up over 50% or down by almost as much. But now, stretch that out. Over any 10-year period, the worst you would have done is lose a measly 2%. And look at 30 years. The worst possible outcome was still an 8% gain. Time just smooths out all those terrifying bumps. Now, the engine driving all of this long-term magic is something called compounding. You've probably heard of it. It's basically the snowball effect for your money. Your earnings start making their own earnings, and things just start to grow exponentially. It's the secret sauce.
And this little story about Amy and Ben is maybe the best illustration of compounding ever. So check it out. Amy invests for only 10 years, really early in her career, and then stops. Ben starts 10 years later, but he's more diligent. He invests for 25 straight years. But who ends up with more? Amy does, by a long shot. Why? Because her money had an extra decade to just sit there and work its magic. It perfectly proves the old saying, it's about time in the market, not timing the market.
So, if we know all this, how do we actually build a strategy that uses patience to our advantage and helps us avoid those panic button moments? Well, it really just comes down to a few simple core ideas. The investment giant Vanguard has spent decades studying this, and they've boiled it all down to four really simple principles for success. They are having clear goals, keeping a balanced portfolio, keeping costs low, and, the big one, having discipline. Let's break those down really quick. Goals are your North Star. They tell you where you're going. Balance and diversification mean you're not putting all your eggs in one basket. Cost is huge. We already saw how taxes can eat away at your returns. And finally, discipline. That's the glue that holds this whole thing together. It's what allows you to stick with the plan, even when that fight or flight instinct is screaming at you. And at the end of the day, that's what this all comes down to. Successful investing isn't about being some kind of genius who can predict the future. It's just about having a good plan and then having the guts and the patience to see it through all the ups and all the downs. So, as we wrap this up, here's the question I want to leave you with. Take a hard look at your own strategy. Is it truly built for the long haul? Is it designed to weather storms? Or is it really just built to react to the next scary headline? Because the answer to that question might be the most important one you ever ask about your financial future.